Good day, everyone. Thank you for joining me. My name is Negate. Today, I'll take you through Diageo's FY21 results. Starting with the executive summary. The company released its FY21 results on the 29th of July. The key takeaways were as follows. So the group's results were largely a bit ahead of market expectations. When we analyzed their product offering and compared that to their close competitors, we're seeing an emerging trend. Momentum is picking up in the spirits business, and we're seeing market share gains being made. I will show a graph of this later in the presentation. Because of volume leverage, pricing power, as well as improved channel momentum, management is confident that it will manage the rising input costs. Overall, organic sales momentum as well as margin recovery is expected to continue into FY22. Though the group is trading at a PE that is high, we think the solid earnings trajectory should support the elevated valuation. For these reasons, we maintain an overweight recommendation on the counter. When we break down the performance for FY21, organic sales were up 16%, and this is because of strong growth that was seen across all regions, with the exception of Europe as well as Turkey. When we factor in forex changes, net sales came in 8.3% higher than the previous period. Looking at on-trade as well as off-trade, on-trade remained severely restricted within this period, with off-trade accounting for over 85% of sales. Reported operating profit was up 74.6%, and this is because it's coming off a low base. Again, it's on the back of strong growth across all regions, with the exception of Turkey as well as Europe. The group continued to have a strong cash generation. We see this from positive numbers in the cash from operating activities as well as high free cash flow. Moving on to the balance sheet, the group has maintained a strong balance sheet throughout the COVID pandemic. Their leverage ratio now is at 2.8 times, which brings it back to the group's target range of between 2.5 to 3 times. Moving on to how the market reacted to the results. Following the results, the market had a muted reaction as the results were in line with the guidance from the management. Share price closed up 0.7% on the day, with the Dow up 0.1% on the day. The share price has outperformed since our last overweight guidance on the 6th of February, increasing by 17%, while the benchmark was up 12.8% over the same period. On an earnings basis, EPS estimates have been on an upward trend, reflective of the strong top-line momentum. We continue to see the company as a high-quality stock with returns ahead of its peers. Here we have shown the ROE trajectory, where you can see clearly that the counter is growing ahead of its peers. That is both the beer as well as the spirit counters. As I've alluded to in the executive summary, we're expecting the spirits to grow ahead of the beer market, as you can see in the graph that's on the right. We are seeing higher sales in the spirits in the US, which is the largest single market, as well as faster recovery in China. Because of these two big economies, we are then expecting strong sales growth for spirits counters ahead of market expectations. While we are positive on the stock, we have some cautionary note with regards to currency headwinds, as well as capex spend, as the company has guided that it will resume their capex spend in FY22. But overall, we're overweight on the stock. Should you wish to place a trade with us, please speak to your financial advisor or contact our trading desk. As we end off, I would like to draw your attention to the following disclaimer. Thank you for your time.